Welcome, everybody, to the Investors Roundtable. We're back for episode 19. I'm your host, Robert Kraft, and joining me today is a fantastic panel, a few returning panelists, but nonetheless, we're very excited to have every single person on here today. We're going to go counterclockwise. For me, I think that might be for you as well. But we got Tom Bachrach from PFH Capital. What up, Tom?
Hey guys, how you doing? Tom Bachrach, PFH Capital. Happy to be here on this totally normal week.
Totally normal week. We also got Yaron Naymark from One Main Capital. Yaron, welcome on this totally normal week.
Yeah, exciting week. I'm excited to be here. Distractions.
Yeah, distractions are key right now. And then we also got all the way from Singapore joining us early in the morning. So we are indebted to him right now. We got Kelvin Seetoh from Slingshot Capital. What up, Kelvin?
Hey, Robert. Nice to be here. My week has been really boring, but I'm amused by things that's happening lately. Wonder what are those things?
Yeah, we're just going to keep trying to imagine what those things are and totally avoid them completely today. I think that's healthy for all of us. But at the end of the day, we do actually have a pretty awesome topic to talk about that has actually, this has gotten a little bit of news in the last week or so. And the topic being compounders, understanding what it means and maybe trying to come up with some sort of definition here, because I would assume it's one of those definitions in finance that, just like value investing, growth investing, whatever you want to kind of title yourself, there's always everybody's own subjective definition of it. So I figured we would take a couple minutes or an hour, or who knows, 2 hours. We're trying to distract ourselves as best we can here to discuss compounders and compounding. So, I'm going to go in order of who hit me up first to be on this episode. So Yaron, kick us off, let's start with your definition of compounding, or what the objective definition might be, and then we'll go from there.
First of all, did you get permission to use that term on this show? Because I don't want to get sued. So
I did actually look up the firm, and I wanted to, I didn't contact them. I didn't talk to the person who tweeted about it either, and I feel for the guy. Like, what a pain in the ass that was.
Yeah.
But you know what? Look, we might just alter the spelling in the title, so it's COMPONDING. So just that's how we're gonna do it today.
Let's talk about compunders.
Yeah, compunders.
So yeah,
you know what? That's what the episode, compunders.
I would say my basic definition of a compounder is a business that. So basically, there's businesses that. I guess I could categorize it in 3 buckets. I haven't really thought of it. Maybe I'll come up with like a fourth or whatever. But like the first bucket of businesses to me is like a cyclical business where like it's economically sensitive. And if the economy is good, if the economy goes through, GDP grows 3%, maybe its revenues will grow 2 or 4. And it depends on what the broader economy will do. You could think of like construction type businesses, for example, or chemicals. Then you have businesses that are TAM, it's a TAM investment. And that type of business is, okay, the addressable market opportunity for this product might be every person in the world, in which case it's like 7 or 8 billion people or whatever the population is. And today we only sell our product to 2 people. So our growth is going to be by penetrating the TAM, getting our product or service to a bigger chunk of the people that we can provide this solution to over time. So if your TAM is $1 billion and your revenue today is $1 million, you can just continue to penetrate that TAM in order to grow your revenue. And then the third bucket, as I think about it, is these compounders, copyright TM, sorry for use, compounders. But the compounder bucket is a business that, in my view, has already reached its steady state, meaning it's already provided its product or service to the majority of the TAM that needs it today, but the TAM is growing at some kind of secularly benefited trend rate that's above the economic growth rate, and that's less dependent on what GDP does. So, for example, like you have compounders like IDEX that sells diagnostic equipment to the veterinary space. I don't have a position in IDEX. I wish I did, but I don't. But basically, everyone who has pets today takes you have a certain number of people who have pets today, and those people take their animals to vets, and they get that diagnostic work done if the animals aren't feeling well, because animals, unlike humans, can't actually speak to you and tell you what's wrong with them. So like if you think your animal's not feeling well, vets are increasingly using diagnostics to help figure out what's going on with animals. And those diagnostics are getting more complex over time. So you can figure out more and more what's going on with animals through these diagnostics. So the utilization rate of a diagnostic test per animal owned is just going up over time. Additionally, pet adoption is going up over time because more and more people want pets. So like, even though you're basically using, the business is kind of mature, given that most people who have pets and take care of them use diagnostics to some degree, but the growth in pet ownership across the country and across the world is growing faster than GDP, and it's probably not that economically sensitive. And the number of diagnostics used per pet are going up. So like, even though the business has penetrated its TAM, the TAM is growing at an above GDP growth rate, and it's very predictable. And it's, it has a secular trend rate that you can kind of underwrite. And these businesses tend to trade for higher valuations than your typical cyclicals, because they have very predictable, durable growth. And anyone who knows the compounding effect, compounded interest is the 4th or the 10th wonder of the world, or the 9th wonder of the world, or whatever. If you grow at above GDP, even if it's 1 or 2% above GDP for an extended period of time, and you get a little bit of operating leverage on that, the numbers in your out years, 10 years out in your DCF, get significantly larger than if you grow even 1 or 2% below GDP or at GDP. And so they trade at higher multiples because there's predictable growth. They tend to be in end markets and industries that not only have secular benefits, but these companies that people categorize as compounders tend to have good market positions and hopefully like an oligopoly or a monopoly position in its end market, meaning there aren't that many other competitors who are challenging these businesses. And so the margin profile is pretty good. The return on capital profile is pretty good. And like, there's so many examples of these types of businesses, whether it's Visa and MasterCard, that people are using less and less cash every year and more card every year. That's a compounder. I mentioned IDEX, I think that's a compounder. You have Invisalign, people used to get wire and brackets to straighten their teeth, but you have a shift every year. More and more people are using these Invisaligns instead of wire and bracket. And more and more people, as they become wealthier over time, they just want straighter teeth. So like, you have a rising middle class and you have a shift away from wire and brackets towards Invisalign. And Invisalign is basically the only player in that market. There are other people who try to compete, but that's a secular growth trend. So these businesses tend to trade at high multiples. They tend to be a monopoly, or in a 2-player, maybe 3-player market where they have a dominant position, good margin structure, and very predictable growth. That's kind of my quick 2-second summary.
That was a long, quick 2-second summary. I think you kind of laid out the lay of the land there, basically. So I mean, Kelvin, Tom, who would like to jump in here to kind of give your own definition as well, or just agree with everything that Yaron just said?
I agree. But as when Yaron was speaking, I also kind of drew something, but I'm not sure I think it's kind of small, right? But anyway, just wanted to say that, the way I look at compounders, I think there's 2 elements to that, right? First is that, just imagine a graph. You have the y-axis, which is your reinvestment rates. Then you have the x-axis, that's your returns on incremental capital, right? So I guess when we look at things like that, right, for a business to earn great returns, for sure a product cannot be commoditized. It cannot be easily displaced by any new competitors. And I think one of the best metric we can look at it is really looking at the ROE, right? Regardless whether it's current ROE or is it a normalized ROE in the case with business that are loss making. But I think it has to sit above like 9% returns in terms of ROE, which is kind of like average returns of S&P 500, right? Because if you look at Charlie Munger, it said that in the long term, companies generate share price returns that kind of matches the internal compounding ROE, right? So I think something above 25% would be really good. But at the same time, when we talk about returns on incremental capital, how can we ensure that it is consistent, right? That's going to be a very difficult question to answer. So really, I think so the way I think about it, it just have to be reoccurring either by subscription or either by a consumer habit, right? It's like we kind of like brush our teeth every morning in a way that's reoccurring as well. That's by enforced by a consumer habit. So the way I look at it as well, like how do we have consistent great returns, is really looking at the value proposition of the business, right? Because at the end of the day, what really generates the financials, right? Financials is really about, I would say, the effects of a good business. But at the end of the day, we have to question ourselves, like, what is a good business, right? Because one of my friends recently shared with me this kind of sentence, which I thought it made a lot of sense. It says that the value of that asset is directly proportional to the impact it makes on the world. So I think all of us really have to kind of think about, like, what's a great value proposition? The product, is it a better experience? Is it a cheaper price? But if it's cheaper price, then currently VCs would fund any businesses. You seem to have unlimited money, so like cutting down prices may not be a good thing. But I think customer experience, a better product feature would be much better. So say, for example, Costco versus Walmart. Why do certain customers prefer Costco? Why do certain customers prefer Walmart? Or even in China, right? Why is JD.com much more preferred than other Chinese e-commerce players? And why is Square dominating over other legacy business? So I think at the core of what I think as a compounder is that a compounder has to provide great value proposition, right? It has to be providing something that there's no close substitutes, which allows it to earn high profits. But at the same time, I start to see that in the last maybe 8 years or so, we have so much VC money that's going around with very low interest rates as well. How are you going to compete with companies that seemingly have unlimited amount of money, right? So I think that nowadays, when I start to see loss-making companies, I'm not really so adverse and to say that, hey, immediately there are companies that do not belong to the compounder category. But instead, I just think about, what are they doing right now? If they are loss-making, are they going to create a better product? Are they going to create a sticky relationship, even a stickier relationship? Because, for example, one of the positions that I hold quite significantly is this company called C Group, Southeast Asia e-commerce player. They are loss making because they have a positive unit economics, and that makes sense because they are trying to like build engagement a lot better. So I guess when we look at the reinvestment rates as well, the y-axis over here, I just think about creating agency markets, right? For example, if you look at Square, it kind of like was a tool to kind of like transfer money first. Then later on, they do like payday loans. If you look at PaySign, they was doing plasma prepaid processing. Then they did pharma. You look at Google, they were doing search engine. Now you have Google Cloud. Yeah, the Waymo, which is not like really taking off. You look at Uber, Lyft, they did transport, then they did food, and maybe something else in the future. So really, I think about reinvestment rates. Like there are not many businesses that could earn a lot of money and reinvest it almost immediately, right? But I think the great businesses that we see that tends to be compounders, they tend to have, they are able to enter new markets with their products. Yeah, like Uber, right? Doing transport and doing food just by using the same infrastructure. So really, I just think it's two things here. Is really your reinvestment rates, and second is your returns on the incremental capital.
So I can take that. I assume you want me to kind of go here now, and I think I agree with everything that's kind of been brought up so far. I think I can take it and kind of try to put it all into one sentence and give you my definition, my one sentence definition of what a compounder is. I view a compounder or a compounder, for avoiding lawsuits from durable capital, as a business that is able to reinvest cash flows over a long time horizon and attractive rate of return. And those are kind of like the three pieces I think matter. And I can kind of unpack them all. We say reinvest cash flows because you don't reinvest net income. That's an accounting entry. You need actual cash flow to pull into the business and reinvest. Yeah, you can go out and raise cash flow from the outside. That's dilution. And it starts to get complicated doing that. Ideally, the business is going to generate cash flow and can reinvest. And, of course, what they can't reinvest isn't part of the equation. If you have a bunch of excess cash and you don't have good opportunities to invest into, you you're likely returning it as dividends to, you know, the investors, and all of a sudden it's our responsibility to compound, not the businesses. When I say a long time horizon, which is kind of the second piece of that, that's just how compounding works. You know, the whole magic of compounding isn't that it does it for a year or two. It compounds over a decade or 20 years or 30 years. That's where like the magic of compounding gets in. And then, you know, anyone that's an investor or follows investing, you know, it doesn't need me to elaborate on why that's the case, but it's just a kind of full mathematical rule. And, you know, I think the takeaway from that is that the business you're looking at to be a compounder needs to have an ample growth runway of attractive opportunities that it can invest into. And ideally, it needs to be somewhat durable in the sense, you know, things like it shouldn't be over leveraged, so it can actually stay on the runway. You know, we have businesses that obviously drive themselves off the runway because they get a little bit too reckless for their structure. And I think the last piece I had in there, so I said compounders are businesses, reinvest cash flows for a long time horizon, and an attractive rate of return. You know, when we talk about attractive rate of return, you know, you can pick your measure. Everyone's got opinions. You know, there's return on equity, return on invested capital, cash return on invested capital. There's a million things. I actually like, you know, Kelvin mentioned return on equity. That's actually what I like. I think GAAP net income gets a bad reputation sometimes, and the key is to check that GAAP net income that feeds a return on equity calculation against actual cash flows, but also to check it against something using like a DuPont analysis so that you can kind of understand, assess the sustainability of what's driving the figure. You know, you can lever up and produce amazing return on equity for 7-8 years and then go to zero, and that's ending at zero isn't really my ideal compounder for obvious reasons. So it's you know, that those are kind of the key elements I would say that defines a compounder, and that's, you know, everyone's ideal investment should be a compounder. I mean, it's for sure it's the ideal investment, and the challenge is of course going to be in finding them and getting back in old value principles. I'm sure we can cover some of that later, but you know, that gives you my definition, at least that gives you.
No, I think now we have a better picture of what compounding is, compounders, you know, the whole deal. And so, you know, the question that I you know, at the outset here is, you know, this subjective definition, and I would argue that all three of you have more or less a similar definition. So where's the subjectiveness, would you say? You know, just kind of to work off Tom, how he broke it down, where we have, you know, reinvest in cash flows, long-term time horizon, attractive rate of return. You know, within those three pillars, what are, at least maybe for you guys, where do you defer, or where are some of the places that you would say, you know, this is actually more important to me within here, or, you know, this is my time horizon, this is what I define as long-term time horizon versus somebody else's, you know? Anybody, Tom, or your own?
Yeah, I would say it's probably quality of the business, predictability of the growth, and valuation that you could buy that company at. And so, in terms of quality, to Tom's point, like if a business is able to reinvest its cash flows at an attractive rate of return for a long time, but then it goes to zero in the future, or in a non-zero scenario, once it matures, a lot of competition will come in and erode the profitability of that business. Then, like, yeah, maybe you built a very profitable business over 10 years, but then your profit gets cut in half because competition comes in, or technology changes the business down the line, or something like that. So I think you want to have a sense that once the business reinvests its cash flows at an attractive rate for 10 years and profits grow a lot because of that reinvestment at attractive rates, those profits at the terminal value will still be valuable, and they'll be valuable if they're able to protect them. In terms of how durable the growth runway is, or how much confidence you have in the growth runway, I think like the more diversified something is and the more formulaic the growth algorithm is for the business, I think people can get more comfortable underwriting that growth over a long period of time. So if you know that 2% of people shift from this to that every single year, or 1% of people do this when they used to do that every year, I think it really helps get comfortable with the long-term growth runway. And then valuation. I mean, everyone knows that if you own a business for 1,000 years, then the entry valuation is almost irrelevant if it can compound its earnings at a long period of time, because at the end of the day, to Kelvin's point, you're going to earn what the internal rate of return of the business is over time. But the reality is none of us own a business for 1,000 years. We own it for 5 years, 10 years, 3 years, 15 years. And so entry valuation really matters, because if you pay 1,000 times earnings for something, and then you know in the terminal year, in year 10 or in year 15, it's going to be worth 25 times earnings, you need a lot of earnings growth to overcome that kind of multiple compression over time. So obviously, if you overpay up front, it doesn't really matter how phenomenal earnings growth is, because you're going to suffer from multiple compression. So you need to have conviction that the business will be valued and be valued well and be able to defend its profitability at maturity. You want confidence in the growth outlook, and then you want a decent entry valuation.
Got it. Kelvin, you want to jump in there?
Yeah. So I got something really I wouldn't say interesting, but just a thought for everyone, right? So to me, like as I was hearing from all of you guys, which have really great pointers, I just thought of, like, if we could give a name to maybe some companies' examples, right? And I thought of one example, which is I think not something that everyone could agree on, but it's this company called Amazon, right? So there are two ways to make money, and that actually affects the ROE, right? So back to making money, like one of it is the high volume game, another one is the high margin games, right? So, and I think that these days, if you have very high margin, it tends to attract competitors quite easily. Unless you are kind of like Visa and Master, like Jeff Bezos once said, your margin is my opportunity. And I think that going forward, let's say we talk about like technology platforms that kind of take rates or commission basis. A better way to make returns is just by going with low margins but extremely high volumes like Amazon, right? So if you think about like the internal ROE, right, that's something that we focus a lot as investors, right? But if you look at Amazon, maybe for context, right, they could be losing huge money right now, but they are actually locking in customers quite rapidly through increasing the value proposition such as Amazon Prime on the platform, and you decide to monetize later by raising prices, right? So do we consider that as compounding? It could be attracting a wide range of opinions here, but to me, I actually think yes, and I also start to get a bit more comfortable, because what Amazon doing today is building that ecosystem for compounding to happen and preventing from any competitors from coming in, because Amazon could report immense profits immediately, like right now today, like just by charging similar to its peers or raising the prices, but that doesn't kind of widen its gap away from its competitors. So they kind of took their money and reinvest in R&D instead. So what do you guys think about that? There are some companies that are just riding the S curve, reinvesting heavily, kind of like building their ecosystem, and they don't show normalized ROEs right now. Do you guys consider that as compounding as well? It's quite tricky, yeah.
I do. So I think if a business requires external funding to grow, I typically think of it as a TAM story. If it's growing rapidly and it requires external funding, I consider it a TAM story. If it's self-funding its growth, in my opinion, and it's growing at a rapid rate, it doesn't really matter to me what the GAAP income statement shows. It's a high return on capital business, because it's using very little capital. It's able to self-fund. If you can grow 100% a year without accessing equity or debt markets, or even if you have to access debt markets, if you're not increasing your leverage ratio over time, if you can grow at a phenomenal rate without having to dilute your equity holders and without over-levering the business, you're growing at good returns on capital, because you're not using that much capital and you're growing very rapidly. So Amazon was able to do that for a very long period of time because it was being funded by negative net working capital. So basically, you pay for something on Amazon today, they get the credit card payment basically immediately, and then they don't go out and pay for their goods. They have payables that they have good terms on that they could pay 30, 60, 90 days later. And so they were using that capital to fund growth. I view that as, I mean, it was a combination of a TAM story and a compounder story, right? The TAM being that basically no one bought stuff on the internet, and one day everyone was going to buy stuff on the internet. But they were also self-funding their growth at a very predictable rate with good rates of return. You know, digital penetration, you know, online purchases used to be 0%, or purchases that were done online as a percent of total consumer purchases used to be 0, then they went to 1, then they went to 2, then they went to 10. I think now they're like in the high teens in the US, and there's no reason why it can't continue to go higher over time in a predictable way. And today they are very profitable. I mean, it's not like they choose to not show profits. Like, even though they're still growing at an attractive rate, they can't, I mean, they can't not be profitable. They don't know what to do with all their cash right now. They're generating so much cash. I agree with you. They could be more profitable, but like, you're widening your moat if you continue to reinvest in the value, in the customer value proposition, and shortening delivery times, and having a better interface with your consumers. So like, I think the fact that they're able to reinvest in widening their moat while also generating a ton of profit is just a phenomenal business model, obviously.
Yeah, so I kind of realized that actually compounders are, you know, like in the past, if you look at how Charlie Munger defined it, you're really kind of looking at ROE, stuff like that. But I started to realize that actually compounders come with different shapes and formats as well. And I really like the way Yaron, like how you explain it, right? Internally funded, externally funded, and I think that really impacts the compounding process. So I really think that was a very neat way of explaining it.
Yeah, and actually, yeah, I'll say on Amazon, and you know, I think all you guys made a lot of good points in there. I think Amazon's a bit of a trap these days because, first of all, not long Amazon. I'm long a Prime membership. That's it. But it's a bit of a trap because I think a lot of compounder people will look at them and they'll point at them. And Amazon was a real once in a generation business. There are many compounders out there, and Amazon stands on an island by itself, not just because it achieved immense success, but because someone was going to achieve the success they did, and they were the one who happened to do it. They were not issuing tons of capital throughout the process. They were financing themselves through their own cash flows. You could argue that for several years in there, their gap income was artificially low as they were building out warehouses and things like that. And actually, their return on equity was really high for a lot of years. You know, going back to like 2005 and 6. So, and in the end of the day, like, your margin is my opportunity, which it's similar to a Costco strategy. Well, like, that's not the only way to generate return on equity. You know, you can generate return on equity through wise leverage, which is what Yaron mentioned earlier with the negative working capital. And you can also juice it with asset turns. They return in assets very well for a while. So I think it's a bit of a trap, because I think what's happened is we have a lot of companies now that say, oh, we're just long-term thinking, like, don't worry about the gap losses. Don't worry about the gap losses. We're just thinking longer term. We're like Amazon, and there's going to be like 3,000 Amazons in the market in like 5 years, according to like what everyone's saying right now. And it's just like, you got to be careful with it, especially, and this goes back again to the points you guys were making. A lot of these people are doing that while they're raising capital because they can't actually generate the cash flow. So you're like, you know, so I think the Amazon example is one to be careful of with compounders. Because it's a little bit unique, and actually it did demonstrate a lot of compounder things, even in the numbers, once you dug into them.
So maybe let's talk of you know, you make an interesting point, you know, Amazon being kind of on an island on its own, you know. Then let's talk about another example of a compounder for our audience that, you know, is more, I don't want to say realistic, because Amazon really happened. That actually did happen. That was on its own. But the idea that another company might imitate an Amazon, I wouldn't place a bet on that, even though the odds are probably nice, especially in the long term. But, you know, let's give what, Tom, in your opinion, what's another example of a compounder maybe that we could break down right now that could help give us a real world example of a compounder, not a compounder,
yeah.
Compounder.
Yeah. So one example, and I'll go compounder actually out of respect for my legal team. The one example that I've given, I know, like on this program before, I'm actually I'm ratcheting through my head right now. I'm trying to think what positions I can disclose right now, and
All of them.
I have a limited list right now, but I mean, one of them which I've disclosed many, many times over the last year and a half, and I think is kind of the perfect compounder is Live Chat, which is the Polish company I've talked about. To me, they are a compounder because they still have a legitimately high total addressable market compared to where they're at right now. So you can look at what their revenue is, what their fraction is, who their competitors are, and what the overall market's growing. You can see a path there. What I like about them is you can look at 10 years of growth, see that they generate 100% ROE every year, and reinvest 20% of that, grow 20%. They take 80%, send it back as dividends. I mean, it's this company which clearly has this massive growth runway, gets phenomenal 100% ROE returns every time they reinvest in a business, and they have room to grow. They could do this for a long time, and so they've compounded already. I think that they have another decade ahead of them.
Wow. I'm just looking at it right now. It's amazing.
Yeah, they're just a phenomenal company, and it's
wow.
But it gets tricky, right? Like, because it's I think a lot of investors look at a company like that and they go, if you're reinvesting incremental capital at 100% ROE, like, why are you paying such a big dividend? And that comes down to some of the nuances you have to look at in the capital allocation, which is that like, if they reinvest 100% of the cash flow, their ROE would drop way the hell down because they're being judicious and picky about their acquisitions. They would have had to start acquiring a bunch of firms. They like organic growth. They don't want to buy anyone. They don't have to deal with any of that crap. They're like, they can keep doing what they're doing and dropping 50% margins. Why would you stop doing that? And when the management owns half the company, they're going to look at it that way, and they probably even like the dividend. So, that's a good example of a compounder. I mean, in the end of the day, it's like the easiest thing to do is go and look who's been generating good ROE, who's been generating good cash flow, how big are they, how big is our market, who's their competition, and say, hey, these guys have proven that they can do this, and I'll be damned, like, they're still a small, tiny piece of the market. So a lot of it just is simple stuff like that. And then the art comes in of, you're making a prediction that they can continue that. And that's where all the kind of scuttlebutt type stuff comes into the analysis.
See, Tom, I'm actually a little disappointed because I could have sworn that you were going to say, oh yeah, look, there's this, I got this Kazakh airport that is currently in the portfolio that's actually compounding like crazy because of Borat 2. I mean, I'm actually kind of disappointed that it wasn't one of those stories.
First of all, I have a couple of the weirdest, stupidest investments you're ever going to hear in your entire life I haven't disclosed yet. So I cannot wait. Oh, by the way, long live chat. I cannot wait to disclose them. I have something that's so stupid you're not even going to believe, and it's in the line of Kazakh or not a Kazakh, Kyrgyzstan airport.
So I try to report in English, by the way. Off topic a little bit.
What's that?
Do they report in English?
No, no. So, it's interesting, right? We talked about this is going to get off topic here, but I actually think it's an interesting subject. There's companies that report in English, and they've already attracted a good number of Western investors, and you can find them in emerging frontier markets and things like that.
And there's companies that will one day report in English.
There are companies that will one day report in English. But even beyond that, you can even go a step further. There are companies that report with scanned PDFs that you can actually either easily use optical, like OCR recognition, so that you can then take the document and feed it through Google Translate and get a pretty good translation pretty fast. There are ones that already just have smart searchable PDFs that you can run through Google Translate. And then there are ones that give you such crappy scans that you can't even use OCR technology on them perfectly well. You can't run them through Google Translate. And so you got to find real creative ways of getting around it. And so, these are like, I think you're going to talk a little bit about how do you find compounders. I think this is where some of the stuff comes in, is just figure out where nobody else is crazy enough to look.
Well, you set up the segue, Tom, and because you actually were even before
segue,
you said
there you go.
Segue. You know, I mean, even before you even said that, when you were talking about how, you know, there's an art to this. And I think that's where we're going to be able to fill in the extra half hour to 45 minutes for this roundtable today, is discussing the art of finding those compounders. So, you know, Yaron or Kelvin, you guys want to jump in there, and how do we identify these opportunities out there?
The way I look at it is that when I started investing, of course, I'm been always focusing on companies which, of course, the ROE has to be great itself. But of course, again, you know, like what Tom had mentioned, you know, like where do you get ROE from? You know, and sometimes the high ROE could be very deceiving as well, especially if they pay out huge amount of dividends that kind of like drain out equity. So what I actually move beyond, like kind of experimenting this year a little bit as well, is really setting the bar really high, you know, for you know, if you look at a corporate life cycle, of course there are certain businesses that they're at maturity, but yet they're compounding really well. So if you ask me, is Costco at maturity? I would say probably slightly a bit early to maturity. But where I'm looking at right now is really looking for companies that's riding the S curve, right? That means at the very start of rapid growth in revenue. And to me, I always ask myself, like, what is going to sustain this huge revenue growth, right? And what does revenue growth really represent? It really represents customers' validation, right? That means customers have a unique, have a satisfaction. You know, they feel satisfied that they will just come back time and time again. It's just like a bit like Costco, right? So one of the company which I think the way I, you know, utilize, so I don't really screen like ROEs these days. But what I really do is to screen for rapid growth in earning, rapid growth in sales. Then, you know, I'll just kind of like go deep into the business, right, and ask myself, like, what's unique about them? Why do they deserve the right to actually dominate in this industry? And to me, maybe it's the way I look at it from the Asia point of view, is that actually there's no short of VC money. In fact, a lot of business that I see today, they make the mistake of reporting profits, or choosing to report profits, you know, instead of reinvesting themselves. And as a result, you know, players who don't mind a lower cut, let's say a take rate, instead of like a technology platform, right? If they don't mind taking a lower take rate, they could actually dominate quite easily, and then they kind of build on the value proposition. So where I'm looking at right now is really, if you ask me about compounders, I feel that I'm actually building a thesis in my head, like what are those businesses that they are loss making today just because they are kind of like building their ecosystem out, and eventually they must have means and mechanism to lock in the customers, either through subscriptions or either through behavior, right? And from there, you know, I must see a very clear path where they could monetize. Because for example, in Asia, where I'm at today, there are two e-commerce players that's battling out, right? You have Lazada, which is owned by Alibaba. You have Shopee, that's owned by C Group, right? And C Group is, of course, you know, undercharging themselves on on obvious intention, you know, kind of to lock in the customer base. And you know, you kind of build a liquidity in the marketplace. You have more sellers, more buyers. That makes the marketplace a more vibrant place. And once you kind of have a like 30% or 50% lead away from your second competitor, and the moment you charge the same take rate, your players will not run away. And from there, actually, as an e-commerce player, your margins are usually very, very high. So really, I don't think there's a exact clear method to look at that, but I really prefer to buy companies that they may not be obvious compounders, but they're emerging compounders. But again, that actually puts things to be a bit more subjective, but that really is where I think deep analysis and meeting people and chatting with them really gives me that unique insight. And of course, I also do think that obvious compounders definitely is on the safer side, but if I'm able to analyze one company that is an emerging compounder that is not known to many people yet, the returns could actually be far more rewarding. So that's how I actually look for compounders currently.
Yeah, I was gonna say, you know, you know, we brought up this idea, or I said, you know, there's an art to it, and I would think some people that are listening in, or some of our, you know, consistent listeners, are thinking, well, is there a quantitative approach? And there's almost an art to the quantitative approach just to get your start even to a degree, So, I mean, that's just my quick comment on that. Whether it was good or not, we'll leave it up to everybody else. Please leave a comment if you thought that was a dumb comment. But Yaron, I saw you took yourself off mute. Did you have a response to that as well?
No, I mean, I was going to just say, I think you find compounders the same way you find every other investment. It's through being naturally curious about how businesses make money, wanting to study them. When there's an interesting product or service that you hear about or that you use or that your friends are raving about, you try to figure out if it's a good business model and if it's public or if it has public competitors. You run screens, you read Barron's, you read MicroCap Club, you share ideas with your friends, and
shout out Ian.
Yeah, shout out Ian. And there's no wrong way to find a compounder or find any investment where you can make money. I mean, if you make money, that's a win. So it doesn't really matter how you find it.
The real advice on how to find just investments in general is never satisfying, I think, for people to hear, because I'm not going to beat an algo or whatever AI or whatever, all the crap I don't understand. I'm not going to beat them, and screening all the numbers and getting that perfectly. I think the way you find ideas, kind of like you guys are just saying, is you develop an unhealthy obsession with investing, spend way too much time doing it. You go down some rabbit holes, and then every once in a while, I mean, I'm telling you, I don't know how I found half my favorite investments. Like, I started somewhere, started doing something else, and then before I know it, I'm like researching this thing for 2-3 weeks, and then like people are like, "Oh, how do you find that?" I'm like, I kind of don't know. Like, you go down a rabbit hole, and you really gotta like investing and be intellectually curious in this, I think. There's no shorthand way to do it. But for sure we can start listing ideas here if that's
Well, I figured maybe this might be a good question here. This could be fun. We talk about value traps out there. So are there compounder traps, or we'll call compounders compounder traps. That's what compounder will now be known as. So, I mean, are there compounder traps or compounders out there? Anybody?
I'll say yes. A compounder trap is one that I think either has less durable growth than you underwrite, or that is lower quality business than the market appreciates, such that competitive dynamics will prevent it from continuing to earn the rates of return that it's earning today, whether it's in the future or very far in the future or very soon, or paying 1,000 times normalized earnings for something that you're underwriting for a 10-year hold period or a 10-year growth runway before it hits maturity. Because I think it's impossible to overcome multiple compression unless you grow a lot. And so if something has an addressable market, if something does $100 of revenue and you think you can get to 300 over time in a very attractive way by reinvesting at attractive rates of return, but you're paying like $10,000 for that thing, or you're underwriting as if it's going to get to $10,000 of revenue, I just think you're going to be disappointed with the outcome.
Yeah, I mean, a compounder trap, if you think about it, right? Like, investments, you put up thesis pillars underneath them about a business. You say, you try to simplify things as much as possible and say, okay, well, I think here's my thesis for why this is a good business, why the price is right, why the timing is right, why all these things are going on. And you end up with certain thesis pillars. And, when you're wrong, usually it's because one or two of them got kicked out. And maybe you got kicked out because you didn't do good due diligence and you missed stuff. Sometimes he kicks out because, well, you did do good due diligence, and there's probabilities in life, and the chips went against you, and of course you need to adjust your belief in those cases. Those thesis pillars, I think, are probably the traps. For example, if you're investing in a business because you think it's run by a capital allocation genius, and that guy is 90 years old, looking at an actuary table would say that under the best chance possible, he doesn't have the time necessary to compound that much further. And of course, I'm not talking about anyone in particular right now. So don't the Berkshire people, please don't start, sending angry messages. Okay, I'm the biggest Buffett fan of them all. All right, so yeah, but that could be a compounder trap, right? A compounder trap could be something that's had an amazing history of growth, but it's just kind of near the end of its growth runway. Compounder trap, you mentioned competitive pressures that could cut way into margins. The margins were never quite sustainable. It's technology. I mean, it's actually, that's the biggest risk with compounding is I think the pace of change now is just a lot faster. Corporate lifespans are shorter. And kind of if you think about it, it's just, you look at this, I'm sure taxi cab medallions, the return was just phenomenal on those for years. And if you were trying to sort out the risk of what was going to kill that, I doubt the cell phone was at the top of your list. And yet that's what it was. So, it could be almost anything. And that's why you got to be cognizant of price paid. That's where price paid comes in. It comes in, you got to be a little bit humble about your ability to predict the future and just not pay a price that counts on everything going exactly the way you plan and hope for in 10 years, because I think that's probably going to get you in trouble.
Yeah, I guess I just want to add on to Yaron and Tom. I absolutely agree with them. I think is actually very well covered. But maybe I just want to backtrack a little bit, how can you find good compounders, right? I think one of the qualitative signs we can look at actually is management, right? So I think looking at transcripts, I think that's really important and certain characteristics that we want. So the thing about compounders is, you can't really describe what the compounders are, but you have some silhouette, some faint ideas, and some clues. It's I would say like a zigzag puzzle, right? So when I look at management teams, I am actually very aware of the words that they use in the earnings transcript, right? Are they innovative? Kind of extend the corporate life cycle, kind of extend that competitive edge that they have. Are they able to innovate on behalf of customers? Are they growth-minded? Do they build great culture? And I think more importantly as well, if they don't talk about it in the earnings transcript, but at least call them up, and ask them about capital allocation, right? How do you actually spend your money? What if there's extra $1 million that comes into your business right now? Where are you going to spend it, and why are you going to spend it, and what kind of returns? What are some hurdle rates that you're looking for certain projects that you have? And I think more importantly, I do discover that most CEOs that tend to thrive for a long time is having this, I would call it a productive paranoia. You want to be productive, you want to be paranoid for the good reasons, and I think over time that's how you kind of avoid compounders, I guess. Yeah.
Yeah, I couldn't agree more. Especially where we all hunt in microcaps. Management and being able to assess management, reading those earnings calls, seeing a video interview that they do, how they're allocating capital allocation. That is all just so crucial to really being able to locate, just winners in general, whether they're compounders or not, just winners in general. I think honestly, I think we pretty much covered everything that has to do with compounding. Does anybody have any final thoughts on where to find them, what it is, or just, y'all have so much experience. Is there anything that, you might want to warn anybody who's watching this to be careful of when really looking for compounders and measuring ROE and all this kind of stuff? Tom?
Yeah, well, here we go. Yeah, I'll do the warning, right? Because I actually make fun of compounder bros all the time. So I should probably drop my warning in, even though I love compounders myself. So I just brought up a quote here, which I feel like is kind of gospel among all the among people who love compounding. It's from Munger. It says, if a business owns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make a much different return than 6%, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you end up with a fine result. And so, it's true. It's like what he says is true. You can prove it out mathematically. Like it's true. Return on capital drives long-term returns. Now, the problem is I think a lot of smart investors have now internalized that lesson over the last decade. And I think we've seen it in the sheer number of compounder pitches that you can find out there. And if they all hit, the market's going to go up for 18, 20, 25% a year for the next 30 years. And that's not going to happen, which means obviously a lot of them are going to be wrong. What I think a lot of investors don't properly internalize is how hard it is to identify and predict ex ante, a business that's going to earn 18% over such a long period, 20, 30 years. And I think it's probably because, we're also arrogant that we think we're smart enough to do this. Predicting the future is really hard. Like I said, pace of change is only accelerated. Companies get disrupted a lot quicker, I think, now than they used to. So, my warning with compounders is this: you should never buy a business just because it's cheap. If it's a poor quality business and it's got poor return on capital, don't buy it. That's a value trap, because it's just going to stay cheap forever because the business sucks and you shouldn't have bought it for what you bought it for. And that said, if you're paying up price-wise on a compounder type that requires you to nail 95 predictions over what's going to happen in the next 10 years, that's going to be tough, and I think, old school value investing is as important as ever right now. I know it's getting out of fashion, but margin of safety and price paid is as much about, it's not about just buying something cheap. It's about, buying something that's not priced for perfection, that's not priced to do what you think it can do. And if it doesn't do it, you're not going to lose as much. And if it does do it, you're going to make more. And in order to do that, you're going to have to look in a lot of weird places. You have to look at spin-offs and all sorts of special situations. And we can go through the long list of places you could look here. But, don't forget value. Don't forget price paid would be what I'd say.
Nice. That was good.
I have nothing to add to that. That was great.
Yeah.
Nothing else to add. That was really great, Tom. Wonderful.
That was A+ right there. I think it's a great way to end it.
Okay, what's happening, man?
No, the new mic drop is like,
all I have is the phone. Sorry, guys.
Yeah, the pod drop.
I think my phone's broken now, so that's a whoopsie.
Oh, nice.
Just
Good
kidding.
stuff. All right, guys. Well, with that, let's get everybody's where people can go and find more information about each of you. So, Kelvin, let's start with you. Where can people go and follow you on social media and find more information about you?
All right, everyone. You can find me at Slingshot Cap. That's ending with CAP. Slingshot Cap. That's it.
Very good. All right, Yaron.
You could find me on Twitter, One Main Capital, the number one, the word main, MAIN, capital, and my website and email address, contact information are on there as well. And unless you are a lawyer for someone who wants to sue me for using the word compounder, in which case you could find my lawyer, actually just reach out to me. I'll give you the lawyer's contact info.
Tom, where can people find you?
And I'm going to say, if your company starts with a D and ends in Herbal, and you want to file a lawsuit or talk to me or be generally litigious, I would ask you to reach out to Bobby Kraft at SNN, and he'll take care of that. And if you want to find me for any other non-litigious reason whatsoever, I always love to hear from non-litigious people. My website is www.pfh, P as in Paul, F as in Frank, H as in Henry, cap.com. And my Twitter is at PFH Capital. And sometimes I even go on there and do stuff.
Very good. All right. Well, look, the name of this episode is going to be What Are Compunders? So we don't have to worry about anything. We're in the clear, and we didn't even, there's lots of definitions. So, we're good, I think. I don't know. I'm not a lawyer. Anyways, you can find more information on me on Twitter at Bobby K Craft, BOBBYKKRAFT. You can follow us on our YouTube channel at youtube.com/SNNWire. And yeah, that's all I got. And hey, a fellow, US people, will get through this week. And Kelvin, I hope you're enjoying the show.
Awesome.
Kelvin,
We
I'm coming
aren't,
to your
but-
couch.
Yeah.
Kelvin, I called your couch right before this program started. It's mine. Okay. I'm going to buy tickets soon.
All right, I'll bring a hammock and be out on the deck. All right, good stuff, guys. Have a good one. All right.